Welcome to WTF, West Bank Talks Finance, where we clear up those what the finance moments by answering your frequently asked questions.
What determines the rate you get from the bank? All right, let's dive into the topic we all wonder about. Why do banks charge interest rates? Well, when a bank lends out money, it's a kind of like taking a leap of faith. They're really hoping the person borrowing the money can pay it back. But as we all know, life is full of surprises, and sometimes things don't go as planned. So how does a bank figure out what to charge? Think of it this way: the riskier the loan, the higher the interest rate. It's all about security for the bank. Now you might be asking, what makes a loan riskier? Great question. First off, the type of loan, if you've got something like a house or a car backing your loan, is called a secured loan. It's generally seen as less of a risk. Why? Because if things don't go as they planned, then we see it as a type of collateral that we can fall back on to repay your loan. On the flip side, this is what we call unsecured loans. They are things like personal loans, credit cards. They're a bit of a gamble for the bank because there's nothing to back them up. No safety net equals a higher interest rate. And then there's your credit score, the magical number that tells the bank if you're the kind of person who pays your bill on time. If you're good, got a good history, the bank sees you're a safe bet, which can mean lower interest rates. But if you're new to the credit game and you have a few unpays, then you're a bit of a wild card and your rate might be higher. So the next time you're looking at taking a loan, remember these points. They're what's behind those numbers the bank is throwing at you. Understanding the game can help you play better and empower you to do what you can do to shape factors that could positively influence the interest rate the bank will give you. Here's how your credit record works. Every month, your credit providers report to the credit bureau, like Experian and TransUnion, about whether your payment was on time. Other credit providers can look at your credit history as part of the processing your finance application. They will be able to see red flags like red payments, maxed out credit cards, judgments, rejected applications. All of these things that make a person look like a higher risk. On the other hand, credit providers will also be able to see whether you've got an excellent credit record by paying your accounts on time, keeping your credit usage low, and limiting how often you apply for credit. So the bottom line is your past debt management directly affects your future finance application. Moral of the story: when you manage your credit like a boss, you will reap the rewards of lower interest rates down the road.
Thanks for listening. We hope that you found it useful. Now go and subscribe to be notified when our next informative episode is available.